And I will share my screen. Can you guys see?
Yes.
All right. Oops. Let me share my entire screen. I think it's actually better for the experience. Can you guys see like the full screen with everybody?
Yeah.
All right. Excellent. Okay, so the topic of today is how do you raise money on your own terms? Like, what are the things you need to do in order to make investors excited about giving you money or investing money in your company? And so I'll start by introducing my venture capital firm, Mighty Capital. We invest in companies that are building what we call products that count. That means products that transform business and life at scale. We start investing at Series A. So that's a little bit further down the line for most of you guys. And you can see here our portfolio, Series A, B, C, and later, as well as some of the testimonials that entrepreneurs have given us with thoughts or perspective on the value we bring to them. And we like to think that we bring way more than just the money to them. In fact, we bring them access to about 300,000 product managers through our sister organization, Products That Count. And Products That Count is one of the largest networks of product managers in the world. We run about 100 events a year. Right now, they're all virtual, obviously, but that's one every 3 days. And we publish content on a daily basis, video, podcasts, articles, newsletter, and more. So we basically, if you're a founder who has a way you can make use of 300,000 product managers, we're a good fit for you, like we're a good investor for you. And you can hire them, like a lot of our portfolio companies will end up hiring product managers from our different networks and such. You can also sell if you have a SaaS product, you can sell it to product managers. Very often, if you have a SaaS offering that you sell either to like someone in marketing, product design, IT, technology, customer success, customer support, all of that, a product manager or a VP product will be part of your buyer process. And so that's a good network to have access to. And then finally, very often, chief product officers are the ones who make decisions to buy companies. And so we also can help you get an exit. And that's the value we bring. So I'll start my talk with, Danielle, you raised your hand, right? You have a question?
Oh,
No.
You just forgot to introduce me.
Oh, I forgot to introduce you. Oh, I'm so sorry. Go for it. Introduce yourself.
That's okay. I'm Danielle Center. I'm a co-founder of BidDrop, and we are using the power of video and community to enhance e-commerce shopping. And right now we're raising our seed round of $750,000. And I'd like to be on this call to hear more about Mighty Capital and your work.
Awesome. Thank you for raising your hand. Okay, so I'm going to start with some myths about fundraising, and then I'll talk about best practices for fundraising. So starting with the myth, many entrepreneurs up until the last few months were thinking like, okay, so I'm going to raise money the way Mark Zuckerberg has raised money, which is, first of all, I don't need a degree to build my business. Second, I don't need marketing or sales, just build it and they will come. And thirdly, I don't need to care about what my investors are thinking. I'm just going to control everything. And I used to work for Facebook. I worked there for a few years. I'm here to tell you that none of this is true, and especially in today's environment. And so, you know, starting with the first point, which is, hey, I just can drop out of college, right? We see these mythical CEOs who are talked about so much in the press, are, you know, billionaires and so on. We say, like, well, I don't need to, I can do just like them. I don't need to get a college degree. Well, that's actually not true, because when you look at business owners, more than half of them actually have a college degree. And so when you compare apples to apples, which is people with a business degree who are business owners and people without a business degree who are business owners, you're actually 6 times more likely to be a successful business owner if you have a college degree than if you don't. And so often when I give this talk to students, I say, oh, you're in the right place, like keep studying. And for you guys who obviously are here because you like to learn, that's the right approach, right, to being a successful entrepreneur. The second myth being, all I have to do is build my product and they will come. And I see that misconception a lot here in Silicon Valley, where, you know, a lot of the founders have a technical background and they say, well, all I have to do is do what I'm really good at, which is build stuff, and then people will find me and buy me. That's nothing further from the truth. You really, really need to do a lot of sales and marketing, and especially in an environment like today. And so, you know, why is that? Well, when you look at the more recent business models of the decacorns, if you look at this screen here of you know, all these companies that are decacorns, there's a couple of things you'll notice. Like the first one is, hey, half of them are from China, half from the US, right? And that's really showing you sort of the changes that are going on in our world. And we have this misconception that everything's coming from the US, but it's really not true. And then the other thing you'll notice is that the business model of most of these companies is actually not advertising based. It's a business model where when you deliver a service, you get somebody to pay for that service, right? Like you provide value, somebody pays for the value, as opposed to you provide some free service and then someone else is gonna, you know, pay for you to use that service. Now, next, so yeah, so stick to the business basics, which is, you know, make money from your customers. It's probably a very safe bet right now, and especially in this environment. And then the last sort of misconception is, hey, you know, investors really should not have a say. So here are photos of 2 investors who maybe you recognize one of them.
Warren Buffett.
Yeah, which one is Warren Buffett? So we know who he is, right? And there's always one person who tells me like, oh, I'd rather take money from the other guy. Do we have somebody who's gonna who's gonna do that? Probably not, right? Because if you do that, you know, first of all, we will never fund you if that's the kind of money you want. But also, what are the benefits of getting money from Warren Buffett as opposed to from that other guy? What are the benefits?
His network.
Advice.
Advice, network, yes. What else?
Follow on. Follow on investments, other people that
Follow on investments, yeah. People trust him. He syndicates deals, yes. What else?
Help with the business model, revenue model.
Yes, he helps with your revenue model.
Credibility.
Credibility, yeah. So if you get money from someone like Warren Buffett, your business is more likely to be successful than if you get money from the other guy. Now, the way Warren Buffett does due diligence, that's a photo of his due diligence approach. So he's not going to write you a check at the coffee shop at, you know, Coupa Cafe in Palo Alto. That's not how he operates. He's going to first understand your business and take the time to understand the drivers of success of the business. Then he's going to look at the management, at your management, and understand who is running the company. Then he's going to look at the long-term prospect of the company. Is this something where I could make a lot of money with, and so on and so forth. And then, is this a good valuation right now? So he's going to do his due diligence like most sophisticated investors. And for people who don't really do their due diligence, you know, who knows what company we're talking about here on the screen?
Enron.
Enron, yes, like that's what can happen when you have investors who are not looking at their investment, like a lot of, you know, agency management and so on. So you really want your investors involved, one, because they're going to help you and push you, and two, because they can also protect you from some of these, you know, scandals. And so really the learning here is you want to get smart money. I'll give you another example from a founder I saw just a few months ago. He was pitching his company, and it was not his first pitch to us. He was doing really well, so we were tracking him and getting to know him. And he pitches an update, and you know, sales going well, and hiring is going well, and business is you know, growing. And at the very end, he says, "Oh, and by the way, the other thing that's really important to share is that we've been approached about an acquisition." And I look at him, I say, "Well, what are you doing here? Why are you raising money here?" "Well, you know, I'm not sure because I don't know if, you know, basically, I don't know how to navigate a situation where my company could be acquired." Well, isn't that the whole point, right? That you get an exit, that you make the big buck, you're successful, your company. Yeah, well, okay. So the next question when you know, you have a first-time founder is, okay, so who's on your board? Who's helping you navigate through these, you know, exciting times, but difficult and rare occasion? Well, that's the challenge. My board, like, I don't really have one. In fact, I took money from, you know, these people who are not sophisticated investors. So basically, they don't know how to advise me. All right, that's what happens when you don't take smart money. You get people on your board or on your cap table who are not going to help you in situations where it's so critical for you. It could be like a life-changing event, but you don't have the person to help you navigate that. So make sure you get smart money. And you know, with that, like the first set of learnings in terms of fundraising is this Facebook model is not replicable. And so in a situation like this, it's like, okay, so, well, then how do you get these investors to love you if you're not going to go and say, like, look, I'm going to be the next Mark Zuckerberg or the next Facebook? Well, that's the focus of the rest of my presentation. And to communicate sort of my key recommendations, I'm going to actually draw a parallel between the way all of you sell your products every day to your customers and the way you can sell your equity, right, pieces of your company to your investors, right? So I'm going to basically do a parallel between building great products that get sold and raising money. And the framework I'm using for that is the 4 Ps, or in this case, there's a 5th P, which will be relevant to some of you guys who are looking to get some, to find a co-founder. So the 4 Ps of building products: product, price, promotion, placement, and then the 5th one, which is your people, which really should be the first one. Okay, so let's dive into the first one. The first one being product. So when you're selling your product, your product's your product. But when you're fundraising, your product is equity. So who knows what this is? What's on the screen here? Who can tell me what this is?
Balance sheet.
A balance sheet. Yes, awesome. I'm gonna, like, do we have like these little clapping emojis here? Anyways, bravo. Yes, thank you, Johnny. Like, let's give it up for her. So it's a balance sheet. And what is the number one characteristic of a balance sheet?
the characteristic, I mean, you need to balance your assets with your liabilities and equity.
Exactly, it balances, right? So at the bottom, you have the two same numbers. So your assets must equal liability and equity.
Mhm.
And so the bigger your assets, therefore, the bigger your liability and equity. And in most of the companies you're building, in most early stage and tech companies, liability is zero, like they don't have any debt. So the bigger the asset, the bigger the equity. The asset is where your revenue goes. Revenue in the form of cash and account payable and stuff like that, right? So the more revenue you have, the bigger your equity, and therefore the happier your investors, right? So that's the first learning, which is when you're like thinking about your product, like the bigger your revenue, the happier your investors. So if you show revenue traction, then you're gonna make your investors really happy. So how do you show revenue traction? Well, I'm using this concept called the business equation. And we start from like really super basic. And by the way, if after this talk, you're like, wow, it's actually easier than I thought, is your takeaway, like, I've done my job. Like, I want you to know it's easier than you think. It's all about like business metrics. So revenue equals number of transactions times revenue per transaction. But some of your businesses have really high velocity and some have really low velocity. And velocity really plays a key role in that equation. So you break down the business equation more like this, like revenue equals number of customers times number of transactions per customer times revenue per transaction. That's really simple, right? But if you're able to articulate how you're going to get more customers, you have your acquisition strategy, how you're going to get them to come back more often and spend more with you, like you're going to drive the number of transactions per customers. You have your engagement strategy, and then how you're going to increase the revenue per transaction. Then you have your monetization strategy. I rarely see pitches that show me like, hey, I'm going to make you happy, Mr. Investor, if I increase my revenue. Isn't that right? Yeah, that's right. Well, my revenue is my acquisition strategy, right? Number of customers, times my engagement strategy, number of transactions per customer, times my monetization strategy, revenue per transaction. Well, here's my customer acquisition strategy. Here's my engagement strategy. Here's my monetization strategy. Like if you articulate that, you have made me really hungry as an investor. I'm like, wow, this person really gets it, right? Like my equity translates directly into revenue growth, like growth of equity translates into growth in revenue. And growth in revenue is a combination of acquisition, engagement, and monetization. Any question on this first? Yes, Hong.
So, okay, in the beginning of a startup, I mean, in the early stages, we're talking about startups, not established businesses, right? This equation is not yet validated in the market.
Yeah.
So we can only present a model we're shooting for. It's not real yet, right? Maybe some things are real, maybe one customer or two or something, right? It's not yet real. Is there a problem with that?
Well, when you do the best you can, right, with what you have. If you don't have data points from the past, you say like, well, this is how I think I'm going to get my monetization or my acquisition. And, I have not proven everything, but I've done some testing, right? I've gotten a couple of customers and they're okay paying me on a per user basis. So that's why I'm thinking this is my monetization strategy. Or I've done some customer development and most of the new people who click on my ads are receptive to this type of messaging. So this is what my acquisition strategy is going to be. So, if you don't have like the past to back you up, you're going to make a number of assumptions. But it doesn't mean you cannot present that approach even when you're pre-revenue. And in fact, I'll tell you something funny. Some of the entrepreneurs that come to us are pre-revenue. We don't invest pre-revenue. But sometimes we help them, we listen, and we give them feedback. And one of these entrepreneurs pre-revenue, or actually 2 months into revenue, very little amount of revenue comes to me and says, well, you know, I value my company, I think it was like $30 million is the valuation of my company, and I've generated $500,000 in revenue so far. So I said, okay, so then you are telling me that your revenue, the valuation of your company is 60 times revenue. Yes, that's what I'm telling you. Okay, so do you know the P ratio of Facebook? Well, it's like 20, between 20 and 30, depends. Let's just say 20. So you're telling me you're 3 times more valuable than Facebook. So this entrepreneur is like, oh, but SC, no, you don't understand. Like, it really doesn't work that way because Facebook is a public company and I'm just like barely into revenue. So if you think about it, like, it actually does work this way, right? Like the ratio of the price earning, right? Like the valuation over revenue, or revenue, sorry, revenue over valuation, it needs to have some form of consistency, because if you start from like a 30x or 60x, and then you need to go down to a 20x, at some point in your life cycle, there's going to be a correction, an adjustment. And the people who are first affected by this adjustment are you. It's not your investors, it's you, the founders, and your management team. And then this entrepreneur is saying things, okay, well, I get it, but you know, I made a mistake. I should have come to USC before I made any revenue, because then like I could have come and made up any multiple because I didn't make money at that time. So it's actually better to just delay making revenue, because then I can value my company at whatever price I want. Well, it doesn't work that way either, right? Because if you're pre-revenue and you start with this super high valuation, then the question is like, how long is it going to take you to work yourself up to that valuation? And can you fund that long time to your valuation with the amount of funding you're going to get and the combination of funding and revenue, right? So if you say, oh, I'm pre-revenue, therefore I'm going to make up a really high valuation when my valuation is really here, then as my valuation increases, like, how much money is that? Am I raising enough funding for that? And if I am I diluting myself a lot? Does that answer your question, Hong?
Yes, absolutely.
Great.
Thank you.
I heard another question.
Yeah, I might be, I just typed a comment because I might be jumping a bit early, but because I don't know where the rest of the presentation is going. But we're talking about a balance sheet, also talking about revenue. And in terms of approaching venture capital, a balance sheet is an interesting one because, I mean, some companies may have a balance sheet and some may not. And it also, the liabilities can depend on how they structured it. But on a balance sheet, that usually just shows accounting assets. Whereas when it comes to a business, and especially, I suppose, when you're talking about businesses that are based on future revenues, there's more economic assets that need to be taken into account. For instance, you could argue that the value of the company is the net present value of, or discounted value of future cash flows, and that's all price per earnings. And I was also just curious that you use the term revenue when other factors that might come into play is that you can show companies may have large revenue and the necessity for investment. I don't know this because we have exactly the same issue, or not issue, but one of the quirks is that we are making, say, revenue, and our actual profit margin is probably about 50%. And so part of the value proposal is to say, we can show that a certain amount of asset creates a certain amount of revenue, but where the real value comes is that it's not just about doubling revenue and therefore doubling profit. We may triple profit because we can hold certain fixed costs. And those concepts are quite difficult to communicate on a balance sheet and quite difficult to communicate on revenue alone, because one, it might be subjective. So I'm just questioning if, presenting a balance sheet is great, but I mean, you also got to try and convey these concepts. And then, then I'm adding one more. The turn of the table is that, as you mentioned, depending on who you are bringing into your business, it's not purely the price per earnings value of your business that might be there. You might say have a proposition where someone says, I want to buy your company, but at a price per earning of 15. Reason being is that the person, the venture capital investment comes with certain value add as well. And you are actually wanting to bring, you put it before, you're wanting to bring certain people into your business, and not necessarily just monetary capital, but human capital.
Yeah.
Sorry, I suppose there was a lot of different concepts there, and I hope it wasn't too disjointed.
Yeah, no, and these are great comments, and you have really solid observations, and you're correct to challenge this model and say, hey, you're oversimplifying SC, because it's not just about revenue, it's not just about PE ratio, and you're 100% correct. I didn't factor in the cost and the profit margin. I didn't factor in that, we may want to look at this business equation by saying, I only want to focus on the new customers, or I only want to focus on the biggest customers, or who is my customer really? Like, I have multiple customers, I have multiple sources of revenue. So the reality for your business is probably going to be a lot more sophisticated than this. But this is a very easy way for me to communicate like key concepts to you, and then you can refine it, right? So your business equation, if you're already at the stage where you're starting to aim for profitability margins or gross margins or whatever you have, it's great. You're going to get to target different kinds of investors who are going to be looking at your cash flow and so on and so forth. But this very, very simple and simplified business equation gets the point across that revenue is what matters, especially in an environment like now.
Thanks.
Okay, so next is the second P. The second P is price. And so this photo here is a photo of my husband's motorbike. He races a Ducati bike. And it's a photo that's taken after a day of racing. He stopped on the way back at this really fancy, fun place. And he was sitting here by the fireplace, enjoying whatever, like barbecue meat or something like this, and I'm not here, and it's heaven. It's like perfect picture. And an event like this, for my husband, it's priceless. An experience like this is priceless. But I'm here to tell you, everything has a price. That Ducati, it has a price, right? And in fact, when you go to the dealership and you try to buy a Ducati, like, you get like a little sticker on the windshield, and it shows you like how much it costs to buy that motorbike. And then when you actually go and you buy it and you get it out of the dealership, generally speaking, you actually spend a lot more money, like, because you spend money on insurance and on extra tires and maintenance and service and all sorts of things, which make your total cost of ownership way, way higher than that list price, right? So we went from priceless to list price to somewhere in the middle. Same thing with your startup. Like, most of the entrepreneurs start off their company saying like, this is going to be like huge, this is priceless, this is my baby, right? And then they get into, like, when they're raising money, they get into fights sometimes with their investor over that valuation, which is the list price. Like, no, it's 5, no, it's 7, no, let's split it down the middle, whatever. But the reality is the true cost is your total cost of ownership, which is your valuation plus the terms. I was telling you earlier that when you get into a down round, which in an environment like we're in today, down rounds are very likely. Well, the investors, like, I don't get hit in a downturn because I have terms that are protecting my investments. But you get hit almost right away because the terms aren't protecting you necessarily. And so what you want to make sure is when you negotiate a price for your company or for your equity with potential investors, you want to look at both the valuation and the terms. And we always say, like, the valuation needs to be fair, right? So that idea of a multiple that's relatively constant over time, that's a fair multiple. Like, if you're in an up market, you could get a higher valuation. If you're in a down market, you could get a lower valuation. But at the end of the day, what dictates these valuations isn't what you can get at any point in time, is what you can get at the end of the game, at the exit stage. And so you're having sort of multiples in that range is the fair thing to do. Having terms that are fair is also the fair thing to do. You're entering in a relationship with your investors that's going to last like, 5-10 years. And so these fairness principles, they actually really matter. And the entrepreneurs that we work with the best, they're basically very easy. Like, we're on the same side of the table, because the minute the money is in the bank and you're starting to spend it, like, we all want this business to be very successful. So that's the second P. Any question before I go to the third one? Okay. The third one is about promotion. So what you see on the left side is that's a sample referral introduction. That's what, for example, that's what I can write when I'm trying to get another investor to invest in a company I've invested in. Basically, it says, I've invested in this company. It's amazing. It's on fire. You should come in as well because it's a great deal. And that's how you want your introductions. And you don't want, there are things you don't want, which are on the right-hand side. So unless you're extremely, extremely early, you don't want to go to Angel List. Angel List is like doing online marketing. You can do it, but when you're selling to like high-end customers, like, for example, people who buy Mercedes, you're not going to go and do online marketing as much. So only when you're like very, very early. You don't want to do cold calling. Like, never do that. It just does not work. And then you don't want to do channel marketing, which is going through an investment bank to raise money. In Silicon Valley, it just doesn't work. Outside of Silicon Valley, sometimes it's accepted, sometimes it works, but in Silicon Valley, it doesn't. So the bottom line being, you want introductions from one of three people. One is an investor who has invested in you and is trying to get another investor to come into the deal. That's the example I'm giving you here. Second is somebody who never invests, but is a subject matter expert in the field that you're building. And you want them to go to investors and say, I'm not an investor, but I'm an expert in that industry or that topic, and I think there's something special there, so I recommend you take a look. And then the third person you want an introduction from is an entrepreneur who has been funded by an investor who says, you funded me, this entrepreneur reminds me of me back when you funded me, I recommend you take a look. So, for example, something you don't want to do, which I get asked to do all the time, is you don't want to ask an investor who's not going to invest to introduce you to other investors. And why is that? So this is how the conversation is going to go. Like, let's say Brandon is another investor. So I'm going to say, hey, Brandon, hi, how you doing? This is SC. Hey, I'm not going to invest in this deal, but really you should. Like, this is never going to fly, right? And so somebody who's not going to invest in you and who's an investor, don't ask them to make investment introduction. It never works. Before we go to the next one, any question?
Yes.
Oh, yes.
So industry expert, from the demand side or the supply side, from the people who would buy the product or service, or from the people who are used to making that kind of product or service? What is better?
As many as you want. Like, if you get multiple people to do that for you, the more the better.
But for you as an investor, who would you prefer to hear from?
Multiple people.
Can you repeat the last type of referral?
Entrepreneurs in my portfolio. Like, so if Brandon is no longer an investor, but he's an entrepreneur I funded, and he's introducing me to a company, I'll be like, oh yeah, he knows how we work. He understands what we look for. We trusted him. We are backing him. I will pay attention to that introduction.
Seems
Thank
like
you.
reaching out to people who have been funded rather than going through and finding like, you know, like what is Mighty Capital and investment? Let's email SC. It's like, let's find out who you guys have invested in, you know, if we were looking for investment, right, from you.
Correct. If that would be a better way, like you wouldn't do cold calling or you wouldn't like stalk me online. I mean, you could, but you do your research, but approach me through somebody who I have funded and convince them like, yeah, I have something, I'm like you, I have something similar. Can you intro me to SC? It's a much better way. And you'll learn a thing or two about this entrepreneur and how they run their business, and you'll develop, you know, expertise. Sasha, you raised your hand.
Yeah, so the question is, we are talking like one-on-one warm introductions. Many early startups go through crowdfunding or try to go through crowdfunding. So I guess question number one, how do you react to the really overblown cap table of those if they put like hundreds of early investors, small investors onto their cap table? And do you consider that more like an economic traction indicator when the startup gets crowdfunded, or it's more for you like the reference from a lot of small investors, maybe not sophisticated ones? Although I know that now crowdfunding can be aggregated, so you get just one record on your cap table, so it doesn't really harm a lot. So what's your opinion on crowdfunding? Do you perceive that as a reference or as an economic indicator?
Yeah, generally it's not a positive. Generally crowdfunding, I'd rather see you do product crowdfunding or rather than equity crowdfunding. So I'd rather you do pre-sale basically than giving away equity, because what it tells me is you don't value your equity. If you're going to give your equity to pretty much anybody, it means you value the other guy, right? Not Warren Buffett. And I don't like that, because I want you to value your equity and treat your investors as partners. So I'd rather you pre-sell your product rather than, you know, pre-sell your equity.
Okay, perfect.
Any other question on this section before we go to the next? Thanks for all the questions, by the way, they're really good. Okay, so the fourth P is about placement. So one of the biggest transition from my past as an entrepreneur to now as an investor is my job as an entrepreneur was to say yes. Like, yes, Mr. Customer will deliver on time. Yes, we'll take on that extra project, and so on and so forth. My job today as an investor is to say no. That is my job. And so, like, I'll give you a couple of scenarios. One is an entrepreneur who says, hey, you know, it's really interesting what's been happening with this whole COVID environment, because basically like half of my staff is completely defocused because they're taking care of their families. And, you know, 2 of my customers have stopped paying me, and, you know, I have another 3 who are probably going to go bankrupt. And, you know, I'm getting constant questions from my existing investors on what's my plan and am I going to raise that next round of funding? Man, I could really use $2 or $3 million to get out of that rut. Well, you've just given me, I don't know, like 5 reasons not to invest, right? All you have to do is give me 1 reason to say no, and it's my job to say no. So compare and contrast that with, wow, you know, we're really like completely thriving. We've totally reorganized our team to take advantage of, you know, distributed work. We have people on multiple time zones, so we're able to work extended hours, and we've adjusted time zones so that people can do their parenting. So the whole team is really coming together. And we've lost a couple of customers, and we're going to take a hit on the revenue, but we've doubled down our sales effort, and we've launched 3 new marketing campaigns. And so yeah, there's still some uncertainty, and we're still going to take some, you know, some hit, and there's going to be adjustments, but we're rolling, right? The train is leaving the station, and I'm going to give you an extra special deal if you come in now. Then I'm like, wow, this person is so completely adapting in one of the most difficult times in our history to the economic condition. Like, when things come back, like, they're going to be thriving, they're going to be amazingly positioned, and they're giving me a really good deal now. Like, what's my reason to say no here, right? So really, when you're going out for money, make sure that everything else is working and is in great order, because your investors, they're going to want to be part of a success. They're not going to, that's not their job to fix problems. Any question before I go to the, actually on this topic, I have another slide, which is this one. So there's also different types of investors, right? And so at different stages and for different types of companies, you're going to have different kinds of investors that are going to be a fit for you. So I call them the whales, the dolphins, and the minnows. Do you guys know what that segmentation is? The whales, the dolphins, the minnows. Has anybody else seen it in a different context?
Like the size of the company.
The size of the company, maybe. The social network folks like Brandon, Aaron. No, doesn't sound familiar. Okay, so in the world of social media and gaming, that segmentation is how people describe their different types of users. So, for example, the whales are the people in like games who they buy all your gears, like they buy the special treasure chests and the feathered armors and the very unique like golden helmets and all that good stuff. So basically, they make all your money, right? It's a very small portion of your audience, but very lucrative. And when you're in a game developer or social media professional, you just do everything they want. It's like whatever you want. Like you want that helmet with like 3 purple feathers. Like, yes, I can make it for you. In fact, we do have one in stock, but we only have one, and it's super expensive. And you could have it, but we only have one. Right? So you make them happy by giving them everything they want. Well, in the world of investing, same thing. There are whales. They will write you a massive check, and after that, they own you, right? Like you have to do everything they want. So if you are looking for that kind of money, these are from all the very big firms, they'll write you 10 million, 50 million, 100 million or more. You need to really understand that you are basically getting yourself into a situation where you're no longer running the company. They are telling you how to run this company, and they own you. And it's fine. For some opportunities, it's the right thing to do. And for some, it isn't. The second type of investors, I'm going to switch to the next one, is the dolphins. And I like to think, Mighty Capital is a dolphin. And basically, dolphins are the kinds of investors who have a competitive advantage in an ecosystem that is relevant for you. So there are a couple of people here who do blockchain. Well, you probably know several of the blockchain funds, and if you get funding from them, they will help you navigate all the complexities around regulation and security and conversion and AML and all sorts of things, because they have a competitive advantage in that ecosystem. Mighty Capital, we have our competitive advantage with the product manager ecosystem. So if you're hiring product managers, selling to product managers, or trying to sell your company to product executive, we can introduce you to pretty much anybody in that trade, and it gives you a competitive advantage. For example, Amplitude, one of our portfolio companies, they say they've generated millions of dollars in revenue from the introductions we've been able to make, right? So these dolphins, why you want their money is because they're going to help you navigate that ecosystem, right? So you'll swim faster if you get their money than if you don't. and their success, sorry, your success is going to be their success. In the world of gaming, the dolphins, just to give you the parallel, are the folks you get an email from like, hey, you should really play Candy Crush. It's really fun. Like, you should come with me play Candy Crush, right? Like, they're your social butterfly. They're the people who helped you like get into cool stuff. And then finally, the minnows. So the minnows in gaming and social, they're basically 99% of your audience. And they're really just here for the show. Like they're lurking on Instagram or Facebook. They don't like, comment, post. They just watch. They consume, and all they want really is they want to be entertained. And so when you think about an investor who's a minnow, it's pretty much the same thing. Like you were asking me about crowdfunding, like that's pretty much what it is, right? If you get like 100 people to give you 10 or 20K, they're going to take a ton of your time because they're going to ask you for an update this and for a coffee that and for a report this and for an introduction that. But at the end of the day, they're not going to be able to do much for you. So at first, like, yes, you need to get some of them to get off the ground, but you don't want to have too many because it's a real time sink. So any question on this before we go to the next?
Why would I take any money from a minnow at all?
If you want to bypass them, if you can bypass them, it could be fine. But most people, they will take some money. They will take money from a few minnows who have like a very specific skill or competency or network. And so if you get, 5 or 10 like super special advisors that are, also investing, like for your business, you may want to have somebody like immunization, like somebody who's with the CDC or something like that, that can be very, very valuable to you. Mm. Dustin, thanks for raising your hand.
Thanks. No, I was just trying to follow the logic there because obviously, the minnows hugely time consuming, benefit value maybe not there. But I got a bit lost between the dolphins and the whales because from your description there, the dolphin sounds like your partner because they're the ones that are going to help you grow quickly, navigate, etc. Whereas a whale might be a once-off big lump sum, but like you said, then they own you. And
Dustin, you cut off for a moment. We'll get back to you once your connection is back. Johnny, go ahead. You're on mute.
I was thinking about what you said with the minnows, like basically having industry experts. Like and what we're doing, there's a number of realtors that are like, let me know when you have your MVP ready, which will be in like a month or two. So with that, it's like they're interested to invest because they know it, they know the space and stuff, so that's kind of a thing. Is that like, that's like, seems like that would be a good kind of minnow money maybe to like come, because it's like, it gives validation to things to, before getting to the point of, or no, are you saying maybe?
That sounds to me like a customer, like people who tell you like, let me know when you have your product ready because I'd like to check it out. It sounds like it would be a great customer. I'm not sure that it's an investor. An investor, you probably want to get like, there's probably like 10 amazing real estate agents, or, like Sotheby's, maybe like a brokerage that says like the top real estate agent at Sotheby's may be like a good investor for you, because then you can go and you say, do you know like Bob Smith from Sotheby's? Oh yeah, Bob, of course, well, he's invested in us. Or maybe you go to like the founders of Trulia or Zillow or some of the early employees there, people in your field, but not somebody who would be a customer, somebody who's like a recognized subject matter expert.
Gotcha. Okay.
Sasha.
Yeah, so obviously you're not advising to take much investment from minnows. What would be your strategy or advice for us to tell the difference really quickly, like in the room, or when you're getting the term sheet, difference between big dolphins and small whales, because it's not that obvious like straight away. Are there any like ring bells in the term sheets that whales always put in and dolphins don't?
Yes, absolutely. And so, you know, it's a great question, because you're basically saying like, I want value add investors, right? And so that's the question you ask every one of them, like the whales, the minnows, the dolphins. You ask them like, hey, you know, I really enjoyed our interactions. I would love to work with you. Tell me what value you add to some of your portfolio companies, or have me talk, like introduce me to one of your portfolio companies, and see like what is the value they bring, right? Because it might be like what you want in terms of value from your investors. You don't want somebody who's just going to be like, keep going, you're doing great. That's like more like a minnow. Like, hey, you know, I'm going to be your coach, your mentor. I'm going to help you out. I'll introduce you to my buddies. That's kind of what they'll say. And then the whales, like what they'll say is, well, look at us. We have 40 years of history. We're a massive brand and we have a reputation and we do, you know, this partnership with, you know, and they will feel sort of like more of a big kind of corporate feel, like institutional, right? The dolphins, what they'll tell you is what I tell entrepreneurs. It's like, well, if you can make use of 300,000 product managers, then we're a great fit for you. And I get one of two reactions when I say that. Like the first reaction I get is like jaw dropping, like, oh shit, these are my customers. Like I definitely want your money and I'll do whatever it takes because you're going to introduce me to 300,000 potential customers. And that's massive, right? It could be a market maker for me. Or like I get, you know, I roll like, good for you, SC, like, but I'm really not interested. I'm doing something where I'm selling to CFOs, or, you know, I'm selling to doctors. So product managers, I mean, I may hire one or two and I'll ping you then, but that's about it, right? So you asked question about the value they bring. I saw Hong, you had your hand raised, and then we'll go back to Dustin, but Hong first.
Yes, thank you. Typically, especially if it's not a whale, the investor at one stage, at some point, we're going to have to raise money from an investor at a different stage, and that's not the same investor. So would the current investor help in raising the money in the next stage, right? Is that part of the value add?
It can be. You know, every investor will tell you that they'll connect you with another investor. But, you know, not everybody does that. Even when they do that, not everybody gets the same respect or listen to the same way. So yes, you want somebody who's an insider. You don't want just like outside money, but that's part of your due diligence. What's the value you're going to bring? Dustin, let's go back to you.
Yeah, I'm not sure how well my connection is going to do now. I think I sort of got the answer. I was trying to understand just from the description that dolphins almost sound more preferable to whales, because whales will control you, whereas dolphins are more going to try and help grow your business. So I was curious about the progression. Why are we progressing to a whale when in reality it sounds like staying in the middle is the best one?
I would agree with you that dolphins, I think, are more valuable unless you need to raise $100 million, right? Like there are companies that will have that kind of need. That's a very, very small amount of companies. It's, you know, in fact, you know, 1% of companies are successful. In that 1%, 97% of the 1% exits for value under $100 million. In other words, in other words, 0.03% of companies will need enough money that they will need to have an exit above $100 million. And so it may be relevant for a whale to invest. But for all the others, most likely it isn't. Okay, so Louis, you have your hand raised too.
Yeah, thanks. In your discussion about minnows, you're kind of brinking in the area of angels. Can you comment on your thoughts about working with angels, both in a round you might negotiate and also on follow-on rounds, their impact to a follow-on round? Thank you.
And so what particular aspect? Because yes, most angels are in that minnows category. So we discussed that, like, what is the particular question you want me to?
Well, you can look at, there are angel groups where you can present multiples at meetings. You can look at them as a way to leverage on a larger scale of more locations. They're a fair amount of work. Just curious what you've seen as far as impact of investor time and effort in that space to raise money and the impact on follow-on rounds. Some angels can be extremely valuable and some aren't. It's really like, think of them as this is a minnow, or this is a group of minnows. And I need some of that money because I'm maybe a little too early to get money from a dolphin. So I'm gonna, need to get their money, or maybe to Hong's point, they will introduce me to some dolphins at some point. But I also want to manage that carefully. And most of the time, it's minnows one by one, but sometimes it makes sense to work with the minnows one by one. It really depends on your situation. Thanks.
Okay, so last point in this presentation before we do just pure Q&A is the people part. And that's especially relevant to, some of the folks who are looking for co-founders right now. So if you're looking for a co-founder, I think there are 3 things you need to be looking for. And it applies also to your early management team. The first one is complementary skill set. Second is compatible communication. And 3 is comparable risk profile. So, complementary skill set, what that means is I don't really like seeing a team where it's like 3 engineers or 2 salespeople. I want some diversity, diversity of skills, diversity of background, because it will make the company stronger. Compatible communication style, it means that we know there's going to be argument and disagreements. Are you able to communicate effectively and come out of this with a constructive solution? And then finally, comparable risk profile. That's actually one of the most important and most overlooked aspect, which is if, say Hong is building a business. Wait a minute, we have 2 people who are co-founders here. Tell me again. Oh, Zohair and Salman. All right. So Zohair, you're building this business and there's nothing short of an IPO, right? And Salman, you're building this business and, if it was going to exit for $10 million, you'd be able to buy 3 Ferraris and you could race your way out of it and it would be awesome. And here comes an offer and it's for $30 million. And Zohair looks at it and is like, it's insulting. I beg your pardon, $30 million, please, you don't know who you're talking to. And Salman is like, oh my God, it's not only success, it's nirvana. Well, guess how that deal's gonna go? It's gonna fail because Salman and Zohair are gonna argue the hell out of this. Let's take it, no way, and it's basically gonna go away. And so you really, when you're looking for a co-founder, you really want to make sure you have, comparable risk profile. And, Zohair, Salman, I don't know anything about you guys, so this is absolutely not related to you. But yeah, you want the comparable risk profile. How I came up with this, in a past life, in my past entrepreneur life, I was looking for co-founders myself, and I had a few friends from.
You're frozen.
I started a. Did somebody say something?
Yeah, you cut out there for a second. I see.
Oh, okay, sorry. So let me go back to that story. How I came up with this. I came up with this because in a past life, when I was an entrepreneur, I was looking for a co-founder, And I had a few, you know, former colleagues, whatever, who could be co-founders, but I wasn't sure they were the right ones. And so I started a network called Founder Dating, professional, you know, networking and matchmaking for people who are looking for co-founders, which means that basically I completely turned the discussion from, hey, hi, Deborah. Hey, do you want to maybe look at doing a company with me, where I'm sort of like desperate because I'm by myself and, you know, nobody wants to partner with me, to, hey, Deborah and Hong and Sasha and Brendan, like, I ran this network of co-founders, of which, you know, I'm a part of, and you could be a part of it too. And by the way, who gets to have first pick at meeting all these potential co-founders? It's me, right? So all of a sudden, I got to speak with thousands of potential co-founders, and I interviewed them. And through basically these, you know, more than 1,000 interviews, that's how I came up with these 3 criteria that, you know, where you want to make sure you have a complementary skill set, compatible communication style, and comparable risk profile. Hong, go ahead. And then Ali after that.
The middle one.
I have a question too.
By compatible.
Raise your hand, Olivier, please. No, I mean, in the...
I don't know where it is.
Reactions. Go to reactions at the bottom.
Participants, and then you'll see adoption.
I just have this as a reaction. I don't have...
That's fine. That's perfect. Okay. Go ahead.
Yes. Can you please explain, expand on what you mean by compatible communication style?
Compatible, it means that when you argue, like you're going to argue with your management team or with your co-founders on certain topics, no matter what, you want to make sure that at the end of that argument, you get out of it and you have a constructive outcome. And some people, they are able to do that. Some people, they aren't. In my opinion, any CEO, that's a must-have, right? It's basically leadership. And is saying, like, it's not about my ego, it's not about being right, it's about what's right for the business. And most people will agree what's right for the business. There's often, you know, one most viable course of action. And if you're not able to get to that most viable course of action, then you actually shorten the time frame. Like, what's the right thing? If we cannot agree on what's the right thing to do, period, what's the right thing to do for the next 3 months? And they're like, I mean, it will be very, very surprising if you got a disagreement. Okay, Ali.
Sorry.
Ali, let's go to Ali. You come back. We come back to you after.
All right, thanks. So the question is, let's say for a company like Uber, let's take that as an example. In early days, they got money from whales. Now, and then they disrupted the transportation vertical. I'm not suggesting that we're going to do that, but just hypothetically, if you're in a vertical and you think that there's a great chance to create something big, would you or should you get money from whales, or you should avoid them?
Mm-hmm. Yeah. So remember the discussion earlier about, like, if your valuation, before you have revenue, you place it so high that it's going to take you a really long time to work yourself up to it. That's basically the situation you put yourself in. If you raise so much money, right, that you need to justify a super high valuation before you make any money, then you're putting yourself in a super risky situation where you're going to go for a long time before you can work yourself up to that valuation. And, you know, even Uber, even, you know, Travis, who had demonstrated through his past that he could generate a lot of value. Even these companies, they raise too much money, right? So when they go public, the stock goes down, right? And, you know, there's still a lot of money that's being made from that. But unless you're, you know, very proven serial founder, this is not a good strategy. You're better off raising a small amount of money on a fair valuation, proving, raising more money on a fair valuation, proving, than like going for the lottery. Olivier, and then we'll go back to Hong.
Yes, in your example about comparable risk profile, if we go back to the example you gave with investors who was happy with 30 million and not happy with 30 million, if you have like two co-founders that are not happy with 30 million, you can end up with a startup where the co-founder are unrealistic. How do you deal with that? Because they're compatible, but they're not going to help the company.
So the next, then you need to have a good board. So I'll give you an example. We hear that all the time. Like we ask an entrepreneur like, hey, how much do you want to sell the company for? And we don't, honestly, like the answer we get, we don't care so much about the number or the answer. We care about how it is answered. And, a great answer will be like, I really want to sell in like 3 years for whatever, something that's like $50 or $100 million. That's a very good answer because it's a realistic prognosis. But we get some entrepreneurs who say, well, you know what, like I don't want to do that. I want to go public. So then the next question is, okay, why do you want to go public? Like most tech companies do not want to go public. They want to stay private for the longest time. So why is it that you want to do what nobody wants to do these days? And then listen to the answer. Or another answer is like, oh, I'm going to, sell this company to Salesforce for like $1 billion, which is highly unlikely. But okay, so how are you going to do that? Like, what is it going to take to do that, right? So it's more like for really understanding the rationale. And if the rationale doesn't necessarily make sense to us, then the next question is, tell us who's on your board. Because the entity that makes the decision ultimately is not the entrepreneur, it's the board. Hong, Danielle, and then we'll wrap up.
Thank you.
Okay, thank you. I just wanted to clarify some more about communication, right? I understand, natural personal communication, but if the company establish a process, right? Like setting up a process to agree on OKRs or PKIs or whatever, then an agreement, I don't mean forced, but people will discuss until they have an agreement and they work on the agreement.
Yeah, so obviously what you're saying is, why isn't everybody focused on their goals and driven by data? Not everybody is like that.
It's
Danielle.
a form of communication in itself.
That's right. It's different communication style, different personality types. Not everybody is driven by what drives you. Danielle. Yeah, go ahead. We cannot hear you.
I was just wondering if you could give some examples of when you've been on a board and good communication styles and how you work when you're on a board.
Being on a board, yes. So I teach a class on governance. I think it's a super important topic. And some of the very basics of being on a board, you want an investor or a board who's going to challenge you to grow to the next stage. And so if you're very early, probably it was just maybe you and your co-founder, and you get an investor on your board, and they're going to ask questions like, hey, can you send me the board agenda and the board material? And you'll be like, what do you mean? Like, what is that? Okay, well, let's establish a standard agenda for board meetings. And let's establish like a standard package for, board material to be distributed to your board members. And then, the board's going to say like, okay, so how did we make the decision to hire whatever, this agency that's costing us a lot of money, like this PR agency or this, FDA approval agency? Well, they were my buddies. Okay, well, can we look at having a competitive process, right? So that's a lot of the value in the early stages that you're going to get from a board. They're going to help you have clean business processes. And then they're also going to help you with fundraising. They're going to be maintaining, or they should maintain a list of potential follow-on investors for you. And you want to pick your board members not as your buddies, because that's really not going to help you, but as people who are going to stretch you and help you get to the next stage.
Okay,
what
great.
I'm going to do now is, yeah, I'm going to stop the share because we're done with the presentation part. And I see some people have put some questions. So how does one show revenue on a balance sheet? Okay, we already addressed that. Prior to create a concrete set of economics, of unit economics, what is your advice for pre-revenue, pre-seed ready? I think, Ali, we addressed that on showing the business equation, like looking backward or forward. Should you avoid whales in early stages? We discussed this. Okay, so we discussed these chat questions. What other questions do you guys have for me?
I kind of ask a question. So it obviously became harder in this COVID-related situation especially for early stage startups. They're so uncertain, so not attractive at the moment for the investors. It's harder for us. Would you say it became harder for you to decide on to whom to give money now and to take on?
Yeah, that's a great question. So there's multiple aspects to the answer. One is just a process question, which is when we make investments, we tend to be, relatively old school. Like we want to meet people in person, and we want to go to their offices and, like get a feel for what things are. And right now we're not able to do that. So it means that we have to do like virtual meetings, and then we're on Zoom, and we're like, are we able to make a decision without meeting a company in person? So that's something that we're grappling with right now, because the companies we started to do our due diligence with like 2 months ago, before, everything unraveled, we've met them in person already. So the decisions we're making now, we're making them based on full data set. But the decisions we're going to make in the next few weeks, depending on, when the shelter lifts and stuff, we may postpone until we are able to meet someone in person, or we may move forward without meeting in person. So that's something that we're going to have to decide in the next few weeks. That's the first thing. It's a process question. The second thing is it's more like a what's the future question, right? Like what's going to be really different, and therefore where should we be putting our attention to? So there are a couple of obvious things. One is we're very fortunate because we're able to make life science investments, and obviously there are things to fix in our healthcare environment, and so that kind of opportunities, like several of you were actually talking about very COVID, relevant topics, that's going to get a lot more attention. I anticipate that there's going to be more funds and more dollars allocated to, fixing healthcare. The second thing is, well, what is, and there's a bunch of industries like this, which will basically benefit from what happened. Then there are companies where it's going to be more or less neutral. So they may take a temporary hit, but it's going to be neutral, right? And that's probably a lot of industries. And then there's companies that are actually going to be hit by, the current environment. So travel is like, well, if you're building a, travel social network right now, do something else. And that's not going to be a very good idea to get any sort of traction or funding, obviously. So, table that idea. Most entrepreneurs have more than just one idea. Table that one, build another, and you'll build your travel website or social network like next time around. So that's the second thing. And then the third thing is when I look back and I look at, what I think could be the closest is 9/11, right? So when 9/11 happened, you know, the world stopped for a while, like, oh my God, like what WTF, what is going on here? And what happened is we then said, okay, so we're not going to do travel like the same way. Like basically we now have airport security. And airport security is like the big change like before and after 9/11, right? So when you think about businesses with this current crisis, like what is the big thing that is going to be different like before and after COVID? I don't think that we're going to live our life like radically differently, but there's one or maybe two major things that are going to be different. Is it, for example, that, you know, massive trade shows and conventions are going to disappear? Possibly. Is it that huge hotels and amusement parks and so on are going to disappear? Maybe, you know, maybe people will no longer want to feel like these dehumanizing, like massive trade shows are as relevant. They're extremely expensive, lots of risks, maybe minimal business impact compared to smaller curated local events, less travel. Massive amusement parks and hotels and, you know, stays and like that kind of tourism, maybe not as relevant compared to like staying in an Airbnb where the risk of infection is much, much lower. So I don't know, like, you know, there's still a lot of uncertainty out there, but what are some of there's probably going to be one or two massive change post-COVID. And that's an area where I would say like there's going to be investments there.
We have a risk to see the price of the flight to go back to what it was in the 80s.
It's possible that prices are going to go down for flights, possible that prices are going to double for restaurants, right? Like if you cannot have like 5 tables like this in a restaurant because you need some social distancing, you get every other table, like that's going to impact the price of a dinner. Like there's just lots of things that are going to happen. What other questions? But by the way, like on this whole COVID thing, you know, I know how disruptive it can be to a lot of you and how like it's really affecting some families and some businesses, and I really empathize with that. But you guys as entrepreneurs and leaders in your community, I want to say like it's your responsibility to really step up. And you know, I tell all my entrepreneurs, like, you be the rock, right? You come up with a plan, you like reassure your employees, your customers, like don't feed into the anxiety, right? Like really just like say, we're going to get through that. And the reason is, you know, if you look at the stats, 80% of jobs in the US are created by companies that are less than 5 years old. And so what you're doing today is going to be, you know, the recovery of the next 2-3 years. And it's your role it's your role and your responsibility to take this on and be the leaders that you are already. And then the second thing is, Seth Godin has this really, really nice saying. He says, just like an epidemic or a pandemic has an R0, you know, coefficient, it propagates at a certain speed. Calm, like being calm, also has a coefficient, right? And so as leaders, just like saying, we're going to get through this, right? It's just a matter of finding the path forward is also going to be helping you be very successful. Yes.
Regarding the domain I'm in, right, with healthcare, with regards to that, what would you think would be a dolphin type investor?
Mm-hmm. There are investors who have raised money from life science, you know, hospitals or pharmaceutical companies, whatever. There are smaller funds who add a lot of value and specialize in your area. And so these sort of you know, high value add, highly networked investors, that's the kind of people you want to be looking for.
If no question, I have another one.
Yeah, go for it.
Okay. I've been involved separately. They're totally separate from that one. I've been involved with startups and companies that raise money through ICOs and those things, right? Can you comment on that? Because that world does not mix with regular investors at all, from what I know.
Yeah. Yeah.
But not through the common ways, right? And they don't lose any equity or anything like that. It's a very different.
Yeah. Yeah. So, ICOs, there's a lot of regulatory issues with them. And so we don't invest in ICOs. But if you talk to blockchain investors, they will do that. And they're usually set up as hedge funds, not as venture firms or sort of hybrids. So it's a very different environment. So I'm going to stop the recording here. And